In April 2008, Mekong Capital, a private equity firm based in Ho Chi Minh City, took an equity stake in Golden Gate, one of the few restaurant chain operations in Vietnam at that time. Within 5 years, Golden Gate expanded aggressively, growing from a single restaurant concept with 5 locations to 9 concepts and 58 locations. By 2013, Mekong was considering an exit strategy, as it was eager to deliver a timely and healthy return to their limited partners and amidst fundraising activity for their new fund. Yet, the exit route and the valuation of Golden Gate were far from certain. There were no publicly traded multi-concept restaurant groups in Vietnam, and few private competitors to serve as a benchmark. The exit might include a sale to a third-party buyer or an IPO on the Hanoi Stock Exchange, possibly followed by a series of secondary sales. The case offers a unique opportunity to study the investment allure of a place like Vietnam, an emerging market that is quickly becoming one of the private equity hotbeds in Asia. It demonstrates how PE firms with an operating focus have a real advantage in sourcing investments in emerging countries. In this case, students will learn how to take advantage of an acquirer's criteria to determine the measures that drive the most value in an exit. In other words, if we're going to have an IPO, what are the characteristics of the market that we're going to be selling into? Or if we're going to sell to a strategic buyer, what specific criteria do those buyers that we intend to sell to have, and how would they like to see the business developed? The case is rich and it's versatile, allowing instructors and students to emphasize certain components depending on the teaching objectives that you want to capture. Continuing with the pedagogical objectives in this case, key takeaways are as follows. Advantage deal sourcing in emerging markets. What differences result when a firm develops a deal origination strategy in order to solicit the best entrepreneurs/companies, rather than relying upon a more opportunistic approach? A strong origination strategy with differentiable points can be a real advantage, even in these limited competition and low-hanging fruit markets. Finding a way to differentiate your firm offers tremendous advantage, both to attract people that you want to attract, as well as in the offering price to be able to buy things on a more economic basis. Deal making in Asia and Vietnam, the famous negotiating books Getting to Yes. Negotiating price and settling disputes can be a very different process in an emerging market than in Western markets. In Vietnam, the concentric rings of family, culture, money, trust, and values can sometimes clash with a Western private equity business school operated mentality. The typical emerging market investing pattern, whereby private equity firms take only minority stakes in a business, make negotiating skills that much more critical. Recognize the difference in how a strategic buyer, a PE firm, or a public shareholder group, if exit is a possibility via an IPO, evaluate a business in an emerging market. A fundamental step in creating the right exit recipe and maximizing exit value includes understanding an acquirer's, his sector, criteria, or what an IPO advisor's benchmarks would be, and determining what measures drive the most value to attract a likely buyer. Aligning the exit private equity firm and company management's interests are key, especially in growth equity with minority positions, as an exit plan will require the full support and cooperation of the company's management team. Buy-in and achieving operational improvements in growth equity investments. How does a growth equity investor, as a minority investor, establish a role in formulating operational strategy and partner in executing operational initiatives? One tactic seen in the Golden Gate case is arranging for business owners to visit best-in-class businesses outside the region and speak directly with sector experts and other entrepreneurs to build the confidence to adjust operations for the better. Private equity expertise credibility to help drive change is essential. Finally, verifying private equity value attribution and Golden Gate results for the private equity firm that's involved. Returns will always be a primary concern for LPs, but how and if GPs really created value for their 20% carried interest has become increasingly important. Private equity firms often point to their ability to increase portfolio value through operational improvements made to the companies they acquire. Due to the predictive nature of these improvements applied through multiple business cycles, a premium is afforded to firms that show demonstrable value added through operations. The LP challenge of discerning real value added results from unverifiable claims is considerable, and a number of services and tools have emerged to help quantify a private equity firm's value contribution, such as the case in Golden Gate. The following questions can be assigned to students to help them prepare for class discussion. Advantage sourcing. How do you win the best deals at the lowest prices? Discuss Mekong's deal origination strategy as it is portrayed in the Cozy Tea scenario and compare it to deal sourcing in the United States or Europe. What might Mekong Capital do to differentiate itself from other private equity firms in the eyes of Vietnamese business owners? Assume you're a partner at Mekong and attending an internal strategy session with partners exploring branding and new business origination. What strategies come to your mind to pursue, and how would you position your firm for preferred deal status? Fragility of the growth equity structure is manyfold. How do operational-centric private equity firms influence direction and execution as only minority owners? Emerging market entrepreneurs are often convinced of their vision and can be quite stubborn in clinging to their views based on their initial success, kind of like venture capital founders that we find in the States. What are the ways that growth equity investors in emerging markets can assess a business owner's willingness to partner together in decision making? Do Western contractual obligations have the same impact on emerging market entrepreneurs as they do in the United States? Mekong owned this business for 5 years, or was a partner in the business for 5 years, before deciding to make a strategic shift and to take operating actions. These changes weren't identified in the pre-acquisition due diligence process, nor were they addressed in the 5 years of Mekong's ownership. What do you assume the role expectation might be of the typical deal leader with a financial background in emerging markets? Is it this operational thing, or is it merely monitoring how the investment is doing? After 5 years, Mekong already had a relationship with the entrepreneur and had supported the prior vision/execution. Do you think it might be even more difficult to advocate change now as Chad Oval came into the picture? Assignment example. A popular assignment when this case is taught at Tuck INSEAD or University of California, Berkeley Haas is as follows. Emerging market exit shaping. The Golden Gate Board of Directors has gathered to discuss the Golden Gate's plan to realize value. Simulate that in the classroom. Which exit would be pursued? And what are the differences in operating strategies in the two exit paths that might be taken? Option 1, expansion. An exciting suggestion was made to reinvigorate revenue growth in Tier 2 cities outside of Hanoi and Ho Chi Minh City. The securities underwriter suggested that owners go public through an IPO and hold their stake for 5 years and then exit in a sale to another private equity firm or a trade buyer after the tremendous expansion potential in these two-tier cities has been realized. Now, option 2, growth moratorium and fix existing units. Chad Oval suggested that Golden Gate shut down new restaurant openings for 6 months, an idea that was practically heresy in the growth obsessed restaurant sector, and instead focus on increasing efficiency in back-of-the-house operations. He argued his case based on the merits of maximizing value now by building a sound platform for a new owner to grow the business and sale to a restaurant chain or a private equity firm. The IPO underwriter from Hanoi Securities has hypothetically sketched out an analysis comparing the two options from his vantage point, as you see now on the screen. Based on the assumptions of opening 300 new restaurants over 5 years, launching an IPO now with all proceeds invested in expansion in Tier 2, and then concluding its sale in year 5. Be aware that in fact the estimate now looks like 500 restaurants in 5 years is a totally achievable target. This case can then be split into 2 parts. Question 1 and 2 would be an open discussion of students' opinions, drawing inferences from the case. For question 3, participants can be split into groups to come up with options, pros and cons of each, and their recommendation.